Okay, folks, let's get started. Two things. One is most of you seem to have picked up your quizzes. There are only about 10, 15 left. I have about 4 left in my office if you haven't picked it up and you want to pick it up. Where's everybody? Come on, it wasn't that much snow. You make it sound like you're at 6 feet of snow. Huh? But not you. People are not here. So why am I picking on you? The other is, I know you don't want to hear this, but spring break is actually pretty close, right? Which is good news. You're saying, why would you not want to hear that? What is due just before spring break? Your valuation is due. So there's good news and bad news. The good news is spring break is almost here. The bad news is if you haven't started your valuation, it's time to start now. Okay? So with that behind us, let's kind of move back to where we were before, just after the quiz. We're talking about growth rates. We talked about historical growth, we talked about analyst estimates of growth, we talked about fundamental growth, and we defined how growth can be different for earnings per share, net income, operating income. And we were doing the very last example, which is in fact the most flexible scenario. The most flexible scenario, you're going to start with revenues, grow out the revenues, then you're going to estimate what the margins are going to be in the future, and then you want to make sure that the assumptions you're making are internally consistent. And here's what I mean by this. Let me go back to the Sirius example. If you remember Sirius, I projected out revenue growth for the next 10 years, and I admitted up front that the number I really estimated was the 10th year's number, and then I worked backwards from it. And in fact, with young companies, that's a good idea. Think about what your company will look like 10 years out, 5 years out, and then use the intermediate years as filler numbers, rather than trying to say, what will revenues be in year 2, year 3, year 4? It's undoable. Okay? So here I started with the end number, 9 billion, and worked backwards. So I've made this company go from being a small company to a big company, right? 187 to 9 billion. I'm being optimistic, but don't value growth companies if you're inherently a pessimistic person. It's not going to work. Because you know what you're going to say. This is not going to make it. The value of the equity is 0, which is fine. If you're pessimistic, avoid buying growth stocks, but don't sit there valuing growth companies. So you got to wear your optimist hat, $9 billion in revenues. But that alone is not going to bail out the company, right? Small revenues to big revenues is half the game. The other half of the game is taking their existing margin, which is abysmal, minus 420%, and making it into a healthy number. There are 2 key inputs in valuing young companies. One is the revenue growth number. The other is this target operating margin. What you think your company will make once it gets past the growth phase, once it becomes a mature company, what will it make? Clearly, there's nothing you will learn by looking at this company's own history, right? It's a young company. What are you going to learn by looking at it? So here's how I estimated the margin in steady state for Sirius. Again, I looked at Clear Channel, largest, most mature company in the sector. I looked at their operating margins, pre-tax operating margins, and their operating margins were 19.57%. I used that as my target margin. So revenues grow from small to large. Their operating margin goes from minus 420 to plus 19.57%. Again, here I knew the starting number. I knew the ending number. And remember what I said, you do not want to be wrestling with year 2, year 3, year 4 numbers, right? So I put it on autopilot. You see what the autopilot mechanism I used was? You get the question, how do I get from that number to that, from that to that? What I said, I did not try to estimate the numbers. The starting and the ending number, I want them to kind of fill out the remaining cells. So it's got to be something simple and something based on the starting and the ending number. You see a pattern? What's my starting number? Minus 420%, right? Where do I want to end up? Roughly plus 20%. What's the distance between the two? 440%. I took half the distance to the goal. Once I got there, I said, now I'm at minus 200%. I still have to get to plus 20. Difference now is 2. Why this mechanism as opposed to any other? The way I adjust this mechanism is if I think the pathway to profitability is going to be rocky, if I think you're not going to get there fast, I move you a quarter of the distance. If the shorter the distance you move towards your goal, the more money you're going to lose for a longer period. You're still going to end up at 19.57% at the end. But if all the spreadsheets I have for high growth let you set this parameter, do you want to go a quarter of the way, half the way? So basically by playing with those numbers, you can set the pathway to profitability. I could have used some elaborate mathematical equation, log exponential, but why? Well, you don't need it, right? If the starting and the ending number, you just want to kind of taper them from where they are now to where you'd like them to be. So their negative margins actually don't turn positive till year 5. They're going to lose money for the next 4 years. And this is my optimistic scenario. But then they turn, and after they turn, they start gradually moving up to 19.57%. So here are the two things that are changing. Your revenues, small revenues are becoming big revenues. Your operating margin is going from a big negative number to a positive number. As the operating margin improves, my operating income goes from a big negative number to a very big positive number. You can do this with any young growth company, right? Take revenues, make them large, take margins, make them. Of course, what's hanging over here is this company might not make it. All your optimistic scenarios might come to naught. But at the moment, at least, put your optimist hat on, get those numbers, come up with a projected operating income. There's one final loose. Yes, go ahead.
I can sort of see why you're going to compare Clear Channel to
Right.
Sirius on the revenues, but for the operating margin, I feel like Sirius is a totally different.
Do you think its margin is going to be higher?
No, I mean I don't know, but Sirius is subscription based, right? And Clear Channel is more
Advertising based, right?
So.
But where do the subscription revenues ultimately not track? Ultimately, it comes to how many people listen to your particular channel, right? So the question is one revenue model going to be more profitable than another? That's tough to tell when all the revenue models with the subscription base are still losing money, right? So the question is, when they become profitable, will they be as profitable as the advertising-based models? That's a good question. Maybe the best place to go for a margin then is not Clear Channel, but maybe the cable companies, right? Maybe some kind, but the cable companies do have a monopoly that does give them higher margins. So, but that's a good point.
Mix and match then.
Sure. Absolutely. In fact, that's a good question. The question was, can I use Clear Channel to get my revenues and a different company to get my margins? Absolutely. Your job is to make the best estimates you can for each input, not to stay consistent. I use one company for one, I have to use it for another. Right? So it is entirely possible. You could have picked a different company or a set of companies. You might say, I don't want to put it on one company, look at 3 or 5 companies to come up with the margin. Yes?
I know that you said that not try to estimate it in the cycle, but what if you had a company that over the years goes from negative earnings to positive earnings to negative earnings? How would you do it?
Well, that's the cycle. But I'm saying if you can't project out when the negative and positive shifts are going to be, don't sit there trying to do this for the next 10 years, right? So you're going to be in a recession, your earnings go down, and recovery it goes up. But if you don't know when the next recession and recovery are going to be, your job is to kind of normalize those numbers. Okay? So the fact that you're putting a smoother set on the earnings doesn't mean your value is going to be wrong. Instead of doing this each year, since you can't forecast out the individual falls and rises, you're going to look at a growth rate that kind of takes the good years and the bad years and averages out across them. Okay? So I'm not saying earnings don't go up and down. What I'm saying is since you can't predict when they go up and down, it's kind of pointless to try to build it into your spreadsheet. Okay? Is there risk there? Sure, bring it into your beta. There will be risk, bring it into a beta, bring it into a cost of equity, but don't try to forecast out year by year what those numbers will look like. Okay? Any other questions? Okay? So this is almost an art form when you work with growth companies trying to figure it out. I'll send you actually a spreadsheet I valued just now of a software company that provides security software. I'll send it to you because there I looked at McAfee, I looked at Symantec, I looked at the big companies, and again try to make it, and this was a company, it's a private company, it's a very small private company. They actually haven't sold any software yet. They've come up with a software prototype. And I've tried to value them based on those companies, but you've got to start with what the sector looks like and work backwards towards your company. So we've got revenue growth and margins, 2 key inputs. There's one more loose end to tie up. That's a lot of revenue growth, right? 187 million to 9 billion. How are they going to pull that off? I mean, remember how we had that rule, if you're going to grow operating income, you've got to reinvest to create that operating income? We need a version of that rule for revenues, right? If you're going to grow revenues this much, I want to see the money. I want to see what you're investing to get this revenue growth. It's not going to happen by itself. Now, this actually is a fairly tricky number to estimate. Okay? You want to come up with a reinvestment every year. You can't use return on capital and reinvestment rate. Do you see why? Why can't you use because that's how we estimated reinvestment for a traditional company. You give me the growth rate, let me estimate the reinvestment rate. Why is that not going to work with Sirius? What's the return on capital right now? Big negative number. What's the reinvestment rate right now? Big negative number. Now you say, this is very convenient. Big negative number times big negative number is a big positive number. That's not going to help you though. Right? You put a big positive growth rate and a big operating loss, guess what's going to happen to that big operating loss? It's going to get even bigger. So here I had to look for a way to estimate the reinvestment without ever looking at the operating income. I know how much the revenues change each year, right? I know they go from 187 to 562. If I can somehow take that revenue change each year and estimate what I need to reinvest given that revenue change, I'm home. Right? If I told you revenues go up by 500 million, if I could somehow use that change in revenues to estimate my reinvestment for that year, I've got a number. So here's what I did. I used a ratio called the sales to capital ratio. Basically, this ratio measures for every given dollar of capital invested in this business, how much revenues are generated. Okay? 1.50. Where do you think I got this number? Where did I get the revenue and the margin numbers? I looked at larger, more mature companies in the sector. I looked to see what you got for $1 in capital invested in this sector. It looks like you can generate $1.50 in revenue. Next step is pretty straightforward, right? I have the change in revenue every year. I have how much I create for every dollar invested. If I take the change in revenue and divide by that ratio, I come up with my reinvestment each year. So in year one, I've got to reinvest $250 million. Year two. So basically, as my revenues grow, I'm making sure that I'm investing capital to create that revenue growth. Notice I don't break it out into CapEx, working capital. Less is more. The less you know about the company, the less detail you want to build into your valuation. Because if you sit there saying, I'm going to forecast CapEx, working capital, you're going to drive yourself crazy. All those ratios are going to be shifting on you. Here you're taking a consolidated number. And for all I know, this might take the form of acquisitions. I have no idea how Sirius is going to create this revenue growth. But I'm going to make sure it pays for it up front in terms of cash flows. My guess is, as they get larger, the only way they can grow revenues this much is by doing acquisitions, which is going to get built into that reinvestment. So every year I compute the reinvestment, I take the change in revenues and dividing by that ratio. So I've got revenues forecast out, operating income forecast out, but those are three separate line items of forecast out, right? So here's my final test. I want to make sure that what I'm reinvesting over this period is sufficient given how much revenues I'm projecting this company will have by year 10. Do you see what the question is? I mean, I've reinvestment. Because I'm not tying reinvestment to operating income, I have no idea whether my reinvestment is too high, too low, or just right. So here's the final number I computed, and I computed based on my own estimates. On the previous page, I projected out operating income, right? Every time you reinvest money, when you see reinvestment in a free cash flow statement, remember that reinvestment adds on to your capital invested. So if you start, in this case, you started with 1.657. That's your existing book capital invested. When I say the reinvestment in year one is $250 million, I am actually building up that book capital at the end of year one to $1.907 billion. Every time you see reinvestment go in, it's pushing into the capital invested. So here's what I did as my final test. I kept track of what my capital invested was over time based on my own reinvestment numbers. I divided the operating income by the capital invested to come up with a return on capital. I know in the early years what it's going to look like. It's going to look awful because they're losing money. But I'm not concerned about the early years. As I get towards year 10, you know what I'm checking to see? Whether I'm ending up with 100% return on capital. If I end up with 100% return on capital, what's the signal that I'm getting from my own cash flows? Am I reinvesting too much or too little? If I end up with 100% return on capital, the denominator is too low. I'm reinvesting too little. In which case, what do? I go back and change the sales to capital ratio to make sure I reinvest more because that's not feasible. I can't end up with 100% return on capital. If I end up with a 3% return on capital in year 15, I'm reinvesting too much. So you can actually tweak the sales to capital ratio, check that end number that you get. So don't worry about the year 2, year 3 return on capital. But as you get towards year 10, I'm checking this return on capital against both the industry average to make sure that, in fact, I'm not ending up with this outlandishly high or low return on capital, and also against my own cost of capital. Right? If I have a 9% cost of capital, I know the number is going to start to drift towards it. I want to end up with a number closer to that cost of capital, not further away. So for those of you working with growth companies, if you're projecting revenues, margins, and reinvestment as separate line items, check this number as well to make sure your numbers are internally consistent. Luis?
The operating income, I guess, after
It's after our depreciation amortization, yes.
The book value is always before.
No, book value is after too, right? Book value is no old book value plus new capex minus depreciation.
So in your formula there, shouldn't you also you're just having capital investment every year?
No, this is reinvestment. This is net capex, right? Reinvestment is net capex plus change in working capital. So that's actually a very good trick to remember. Is when you see reinvestment in a cash flow statement, that's how much you. So if somebody asks you, what will my balance sheet look like in year 8, you can actually build up to it using your own estimates of reinvestment in original capital investment. Any questions? Much messier, right, than what we did when we had nice stable. But that's the nature of the process. If everything is changing, you got to kind of make sure that the numbers you're estimating internally are not at war with each other. Yes?
For some distressed company, if you acquire a distressed company, let's say the revenue will come and decrease first couple of years and then
It's fine.
how do you calculate and
What's the difference, right? You could go. Nothing in what we've done requires positive revenue growth. If I put -8 in the first year, -5, the whole process still follows through, right?
then the change in revenue will be negative.
Right. So,
So
and what do distressed companies do? They sell assets, right? When you divest assets, what do you get? You reduce your capital invested. So in fact, it's internally consistent. If you're telling me revenues are going to shrink and the company is going to sell off its idle assets, assets that are not directed, you're going to end up with a negative reinvestment. There's nothing wrong with a negative. Basically, what you're doing is you're drawing down capital invested. You're shrinking as a company to make yourself healthier.
but isn't it that what you reinvest, you may be redeeming the rewards 2 years from now?
Okay, that's a different question. That's got nothing to do with distress or high growth. I'm assuming contemporaneous reinvestment and growth. Do you see his point? Which is to get the $375 million in revenues in year 1, I'm assuming you reinvest $250 million in year 1. But what if you're in a business where what you invest this year shows up 2 years from now? How do you modify what we just did? It's actually very easy to do. Okay? Did everybody get the question? Let's say there's a 2-year lag between when you reinvest and when you get revenues. How would I estimate reinvestment in year 1? Take the revenue change in year 3 and divide by 1.5 and you get the reinvestment in year 1. So it's mechanically you can build in lags, you can build in in a sense, it's flexible enough that you can build in whatever, you can build in a 5-year lag, right? All you need is the year 6 change in revenues then to get the year 1 reinvestment. So the process is flexible enough that you can allow for that, but make sure your lags then are reasonable lags. Any other questions? Okay. So, yeah.
I mean, intuitively, we're looking at trying to make sure that return on capital employed is at a reasonable number.
At the end, not at the beginning. No.
At the end, you're
Right.
trying to kind of normalize even the valuations per se for all companies.
I'm just saying that in a comparative business, steady state, you're not going to be making 30% return on capital if everybody else is making 10. If you're the best company in the sector, you might be making 12, not 30, right? So I'm not saying you have to move, but you have to move towards the industry average. I don't care who you are. You could be the best company. As you get larger, the nature of competition is such that your returns will get sucked down towards industry average. I mean, when you're small, you can have 40% returns on capital. When you're Microsoft size, guess what? Its returns on capital are going to move towards the industry average, partly because it's going to be a much bigger part of the industry. So it's almost mathematical. It has to move towards the average. It doesn't have to move all the way to the average, but it has to move towards it. Right? Any other questions? So let's summarize. When you look at growth rates, you can either look at equity earnings or operating income, right? If you're looking at equity earnings growth rate, there are 3 ways to estimate it. You can listen to analysts who tell you what the growth rate is, but we've already talked about how useless that is if you go past 1 quarter. You can look at historical growth, but there again you got to factor in the changing size of the company, and you also have to factor in all those mechanical issues, negative to positive. Or you can look at fundamentals. If you're looking at equity earnings, those fundamentals can be defined either in terms of earnings per share or net income. If your growth rate is in earnings per share and you have stable return on equity, you multiply the return on equity by the retention ratio, you're done. If you have changing return on equity, you get the efficiency growth, the change coming from changing return on equity. If you have net income, mildly different variations of the retention ratio, you focus on the percentage of net income that you reinvest back. The big difference being retention ratios are capped at 100, bottomed at 0. Equity reinvestment rates can be greater than 100% or negative. So that's the equity earnings side. If you're talking about operating income, again, you can look at historical growth or fundamental growth. Fundamental growth, we have stable return on capital. You have return on capital times the reinvestment rate. If you have changing return on capital, you've got this additional factor. If you have negative earnings or unstable earnings, I should have added that as a qualifier, unstable margins. So margins are changing. If you have negative earnings or you feel your margins themselves might change, then you got to do it in 3 steps like we did for Sirius. Start with revenue growth, project out margins, estimate the reinvestment, check your own numbers. Okay. One of the things I will do on your valuation is I will not contest you on your growth rates. You know more about your company than I do. So if you say 20% growth rate, I'll say, okay, that's what you think, that's what's fine. But I will check your internal consistency. If you tell me 20% growth rate while reinvesting nothing, then I'm going to say those numbers don't make sense. I can check for internal consistency. I can't check for whether the numbers themselves make sense. So part of what I would try to give you back is these numbers seem inconsistent, but you can start doing that yourself. As you go through, check within your... So don't just check, is this... Because often when we check each assumption, we ask, is this assumption reasonable? Which is a good question to ask, right? So you have 10 inputs, is that reasonable? And you might say yes to all 10, but then you have a final question to ask. Are the 10 inputs consistent with each other? And what I'm assuming about growth and margins and reinvestment all makes sense for this one company. Think as if you're running a business. It's not just a bunch of inputs on a spreadsheet. As a business, you got to pull off all these numbers at the same time, and that is what consistency ensures, is those numbers match up. Any questions about growth? Okay, so the key message with growth is don't let it become an exogenous input. You know what I mean by exogenous? Don't sit there saying, let me try 10% growth. Let me try 12% growth. Let me try 14% growth. Because then your valuations are truly unbounded, right? Because you can just keep pumping up the growth rate till you end up with a value that's equal to the market price. That's not the purpose of valuation. That's not what we're trying to do in valuation. You have to start thinking of growth as something that comes from what the companies do internally, not from outside. So we've talked about discount rates, we've talked about cash flows, we've talked about growth rates. We're almost there. There's one number we haven't talked about, and this is the elephant in your living room. The big number that ultimately is going to drive your valuation, which is that terminal value. So I want to talk a little bit about terminal value. Let's step back. You know why we need a terminal value, right? At least in theory, publicly traded companies can last forever. We can't estimate cash flows forever. So at some point in time, we say, I'm tired of doing this. I'm going to stop, and I'm going to estimate what the value of my business or equity is going to be at that point in time, year 5, year 10. That's the terminal value. So effectively what it does is it allows you to close off your valuation at year 5, year 10 by bringing in what happens after that point in time. There are 3 ways in which people estimate terminal values. One is wrong, but it's the most common way of estimating terminal value, and I'll talk about why I think it's wrong. And here are the 2 other ways. Let's talk about the one wrong way first and get it out of the way. You know how most people, or most DCF valuations on Wall Street at least, estimate terminal value, right? How do they come up with value in year 10? They apply a multiple. If you're going to apply a multiple to the terminal and get a terminal value, don't tell me you're doing a discounted cash flow valuation. This is a charade. You're doing a relative valuation with a discounted cash flow front because your biggest number is being driven by 8 times EBITDA, right? And where do you get that 8 times EBITDA? By looking at what other companies, in other words, you got it by looking at what other companies trade at right now. You've transported it to year 10, and now you're saying this is a discounted cash flow valuation. I would say 60% of all DCF valuations on Wall Street are not discounted cash flow valuations. They're just forward multiples because the biggest number comes from... There's nothing wrong with relative... Did I lose my mic? No, I'm okay, right? There's nothing wrong with using relative valuation, but call it what it is. It's a relative valuation. So let's cross that out. If you're going to do a discounted cash flow valuation, an intrinsic value of your company, your biggest number can't come from looking at what the market is willing to pay for other companies right now. Which leaves you with 2 other ways of estimating terminal value. One is liquidation value. The other is a going concern value. In a liquidation value, you shut everything down, you sell your assets, right? You figure out what you'll make. In a going concern value, you assume your company keeps going after year 5 or 10 and continues to produce cash flows, and you try to capture the present value of those cash flows by assuming that those cash flows grow at a constant rate forever. So when you see a perpetual growth model estimating terminal value, you are implicitly assuming a going concern. Now, stepping back from a common sense perspective, liquidation value versus going concern value, which do you think is going to give you the higher number? You break a company apart, you sell off the assets. Let's say you do it on eBay, Craigslist, whatever you decide to do, right? Or you keep the business going. Generally speaking, going concern value is going to be higher than liquidation value. So this is easy, just go with the going concern value. Here's what's going to determine which one you use, though. If I come to you with a small private business, a restaurant, and you're the owner, and you're 52 years old, might make more sense. Say, look, you're going to run the business for another 15, 20 years, then you're going to shut the business down, and here's the liquid. You might have only a 15-year lease on the business. So there might be a logical endpoint for your business, at which point you really are going to get liquidation value. There's no point putting a going concern assumption, coming up with this big terminal value if the business is going to run only 15 years. So if you have a finite life business or you have a private business, liquidation value might be a more legitimate way of coming up with the terminal value, of the end value, than assuming it will keep going forever. If you have a publicly traded company, it's generally a better idea to have a going concern value, because this is an ongoing concern. You should be able to sell it as a business for more value than what you would get by selling it in pieces. So that really should determine, do I go liquidation or going concern? It's not, don't toss a coin and say, which one do I use here? Think about what you're valuing, and that should give you a sense of which approach works better for you. But don't use a multiple to get the terminal value, because that kind of undercuts the whole point of doing an intrinsic valuation. So most of you are going to end up, because you're doing publicly traded companies, that stable growth model, right? And stable growth model, very simply put, yes? Anthony? Just to estimate how much I reinvest, right? I'm not estimating value. The one number I don't want you to estimate. I mean, cash flows, margins, return on capital, you have to look at what the sector is making, because those are fundamentals coming from operations. Operating numbers, I'm looking at the sector, betas. Right? The one number I cannot get from the market is the value number, because once I get that, why am I wasting my time doing a valuation in the first place? That's a relative valuation. I use a multiple, I apply it to some earnings number. So if my job is to do value, I'm saying, given the operating characteristics of the company, what is the value of the company? I have no qualms about pulling operating numbers from the sector. But if I let the value number also come from the sector, what am I contributing to the valuation? So I'm not saying don't use sector-wide information, but don't use the pricing of the companies as an input to your valuation, because then you're in a circular logic. I mean, if you tell me the market price is right already, why waste your time doing a valuation, an intrinsic valuation of the company? Okay? So it's not that I'm saying ignore the sector, but ignore pricing inputs from the sector when you value the company, because in intrinsic valuation we're asking, is that price right? Okay? So this is a stable growth model. Right? Value the firm in year 10 is the cash flow 1 year after. That's a present value requirement. Okay, so to get the terminal value in year 10, you always need the cash flow in year 11. To get the terminal value in year 5, you need the cash flow in year 6. Okay? So numerator, you got the cash flow 1 year after your terminal year. And in the denominator, you, of course, have the discount rate minus the growth rate. Which one uses your discount rate will depend on whether you're getting a terminal value for equity, in which case you use cost of equity, or terminal value for the firm, in which case you use cost of capital. Take a look at that equation. If I let you hold everything else constant, it's very trivial to increase your terminal value, right? All you need to do is sit there and keep moving G. And small movements in the growth rate will translate into big movements in value. It's every analyst's favorite device for pushing up the value of a company, is play with the growth rate. Mathematically, what happens is the growth rate approaches the discount rate, your terminal value is going to explode. And sometimes analysts get so carried away with playing with the growth rate, they push it right through the discount rate and pass. In which case, you get into some serious trouble, right? Because then R minus G becomes negative. You get a negative terminal value. You say, model doesn't work. Look, I'm getting a negative terminal value. It's not that the model doesn't work. It's that you don't work, right? You can't put in a growth rate of 12% forever, because mathematically it's not going to happen. So we've talked about this. We've talked around this issue. So let's visit this state. So we're not talking about growth for the next 10 years. There you can put whatever growth rate you want. Now you've told me your company is a stable growth company. Let's talk about what that stable growth rate should look like. First, that growth rate cannot be greater than the growth rate of the economy in which you operate. Right? You see what? Mathematically, if you let a company grow faster than the economy, at some point in time it is going to become the economy, and then what? You think people violate that rule? In fact, to see if people violate that rule, let's see how high that number can be. If I were valuing a U.S. company in U.S. dollars, what is the highest stable growth rate I can use right now? The risk-free rate, right? Why the risk-free rate? Because the risk-free rate is expected inflation and expected real rate. The growth rate of the economy is the risk-free rate plus the expected real growth rate. In the long term, the two numbers should converge. Built into your valuation is already a clue to what your stable growth rate cannot exceed. You used a risk-free rate of 3%. Your stable growth rate cannot be greater than 3%. It might seem like a rigid rule, but don't mess with it. It's the easiest way to let your valuations kind of go unbounded is to let their growth rate exceed your risk-free rate. Yeah. You can use an expected rate. You can use a forward market to get an expected rate. But you know what? What's a forward 10? If the rate today is 3%, I guarantee you the 10-year forward rate is not that far from 3%. The T-bond market is not like the gold market or the oil market, or the futures price could be any number. It's actually tied very closely to the spot rate to prevent arbitrage. So it turns out that even if you use the 10-year forward rate, I guarantee you right now it's going to be 3.08%, 3.1%. No, that's not what we're assuming. We're assuming that if we mess up on the risk-free rate, we have to mess up on the growth rate in the same direction. Do you see what I'm saying? If you think the risk-free rate is too low, then the growth rate has to be the same level. So if you think the risk-free rate is going to go up to 5%, okay, then the growth rate can go, so if you decide to replace your risk-free rate from 3 to 5%, then you can change the growth rate as well. But you just can't change one number. Because if you do, then you create an internal inconsistency. What it does is it keeps your valuation in sync. So if risk-free rates are too low, the growth rate is kept low as well. If risk-free rates start rising, the growth rate rises with. So in a sense, it allows your valuation to stay internally consistent and lets you focus on the things that matter. What are your company's margins? So you can then focus on those 10 years when you can play with the growth rate, play with the margins, and not use the risk-free rate and the growth rate as devices to kind of push up your value for your company. So it cannot exceed the growth rate of the economy, and the risk-free rate is a good proxy for it. Can it be 0, your stable growth rate? Why not? I just said the cap was the risk-free rate. I didn't say every company has to grow at the risk-free rate. In fact, I can safely predict that mature companies will grow at a rate less than the risk-free rate. Do you see why? If the overall economy is growing at 3% a year, and the overall economy is composed of growth companies and mature companies, then almost by definition, mature companies should grow at rates less than the 3%, right? So 3% is the cap. And of course, that cap will vary depending on what currency you're doing your analysis in. Pesos, the cap will be higher. But it can be below that number. It can be 2, it can be 1, it can be 0. Can you use a negative growth rate forever? Can you put minus 2% a year forever? Absolutely, it'll work. With 2 caveats. If you put a negative growth rate, your reinvestment rate will be negative. Your company will shrink over time. In life cycle terms, you know what you're assuming when you use a negative growth rate? Your company peaks in year 10, and then it starts to get smaller over time, which actually is the way life cycles look in most life cycle books, but it's only notice that in valuation, every company becomes GE, or GE as it used to be, not GE as it is now, right? Because we make every company grow at 3% a year forever. How do these mammoths coexist in the same economy? So keep open that possibility that your growth rate will be well below the risk-free rate and may even be negative if you're in a sector which you think is going to be a declining sector. Yes? Use the global real growth rate, but you still have to stick with the currency you're doing your analysis in. And don't let that be a license to push the growth rate above the 3%. All that will mean is if you have global growth, maybe say their returns on capital and stable growth will be much higher than this other company. Don't let the growth rate be a device that you let have play in it, because one company is a global company, the other company is not. Okay. Any other questions? Yeah.
Just for a global company, then what will be the risk-free rate you use?
what currency you're going to do the valuation in. It's got nothing to do with being a global company. You have to pick a currency. You pick the currency, you already picked your growth rate cap. You do it in Swiss francs, it's going to be 2.2%. You do it in Japanese yen, it's going to be 1.6%. Right? So your currency choice is also going to determine what your what your cap rate, what your cap on your growth rate is going to be. Question back there. Not all the growth rate. The growth rates of mature companies have to be less than the growth rate of the economy because there are growth companies, right? This is when your company gets to steady state, but you have other companies coexisting at the same time that have 10 years of high growth left in front of them, right? So if all your mature companies grow at 3%, you have a problem. Where do your growth companies go then, right? Because the weighted average growth rate for the entire economy has to include mature and growth companies. So it's not that all companies grow at 3% starting right now, but the mature companies right now have to grow at less than 3% for the growth companies to make up, or grow at a rate higher. Right? Here's what I want to do. Right? I want to actually introduce somebody had a question. Yeah. Don't. For the simple reason, if you use a historical average in the GDP and you revert to a current risk-free rate, you can create a mismatch there. So you can use real GDP growth if you want, but if the market right now through the risk-free rate is sending you a different message, you can't receive that message in your risk-free rate and abandon the message on your growth rate. Okay? So when it comes to stable growth, just let the risk-free rate be the cap. Don't go looking for trouble because it's very easy if you violate that rule for your valuations to start blowing up. I've seen it, especially in the last 4 months, I've seen people using 4, 5, 5.5% growth rates using the argument that's what the real growth and inflation is, and moving their risk-free rates to 3% because that's the current risk-free rate. You can already tell what's going to happen, right? I don't even have to look at the valuation to know that they're going to find everything they look at looks undervalued. And it's not because the company is a great company, but because they've taken a point of view about growth and risk-free rates in the valuation that are internally inconsistent. So first rule with the terminal value is don't mess with the growth rate. Cap the growth rate. Malik?
Yeah. So where would I find spread global real growth rate?
If you're looking for it, you can get it for last year, right? That's always a problem. You can get real growth rates for last year. You can get inflation rates for last year. The only forward-looking number you're getting is a risk-free rate. That's why I'm saying don't worry about real growth, because if you go look at the OECD, they'll give you what the growth rate was last year, but it's kind of useless, right? Because what you want is a growth rate, not just now, but forever. It's not what will the growth rate be next year. We're talking about starting in the year 2018, what will global real growth be? And who wants to wrestle with that issue? It's tough enough valuing your company. Why do you want to get your mind even around that concept? Let the risk-free rate be a decision, saying markets can be wrong, but at least they're wrong in the same direction in both places then. Lower risk-free rate, lower growth rate, higher risk-free rate, higher growth rate. So let the risk-free rate take care of that. Don't even worry about the real growth rate. Don't worry about inflation because it's embedded in there. Any other questions? So that's the first rule, obey the growth cap. Second, don't wait too long to put your company into stable growth. Right? You know what I mean? So you're sitting there in a spreadsheet saying, do I give them 5 years? Do I give them 10 years? And it's so easy in a spreadsheet. You can make it 50 years. But this is an empirical question, right? How long does high growth actually last for a growth company? In fact, let me pose that question to you, and I'd like an intuitive answer because I'm going to kind of put a generic growth company in front of you. This is a company that's just gone public. It's got great growth potential. So trust me, right now it looks like an incredible growth company. It just went public 2 days ago. How long do you think growth will last for this company? I mean, it's a generic growth company. How long? 5 years, 10 years, 15 years, 20 years? Because that's going to determine what you use as your growth period. I'm going to show you a graph that is, I think, incredibly scary if you're a growth investor. This is a graph that actually looked at IPOs. These are high growth companies. They've just gone public. It compared the revenue growth rates of these companies against the revenue growth rates of the sector. So I'll give you the good news. The first year after they go public, the revenue growth rate of these high growth IPOs is 15% higher than the growth rate of the sector in which it operates. You think they're a high growth company. 2 years later, the revenue growth rate of these same companies relative to the sector is about 7% higher. 3 years later, it's down to 3% higher. These are the same companies being tracked, 1 year out, 2 years out, 3 years out. In fact, by the time you get to 5 years out, look at what happens to the growth rate of these companies relative to the sector. Growth fades much faster than you realize in the real world. For 2 reasons. What are the 2 reasons growth fades at these young growth companies? One is competition, but there's an even bigger mathematical factor driving down the growth rate. They're getting bigger. We forget how much scale. We talked about it in the context of historical growth, how scaling affects your growth. The 2 biggest enemies you have as a growth company is your own success makes you bigger. The other is your own success attracts competition. I mean, it's tough to read too strong a message here, but when you sit down and you put in a 10-year growth period, as many of you will for high growth companies, say, oh, that's not too bad, 10 years of growth. Remember, you're already pushing the outside limits of growth. There aren't that many companies historically that have been able to pull off high growth for 10 years. And you can name them, right? Walmart, Microsoft. In fact, that we can name the companies that have been able to grow at high rates for extended periods tells us what about these companies? They're the exception. So when you sit down and put a 10-year growth rate for your company, you're already making it one of the exceptions. Don't make it even more exceptional by making the growth rate 25 years. Because then you're saying my company is a one of a kind. That might be, but do you want to price the stock today as if it has to be one of a kind for you to break even? So be cautious about growth periods. As you push the growth period out, you're already hitting very quickly limits on how long growth can last. So obey the cap and think about putting your company into growth sooner rather than later, right? Because don't push it off to 15, 20, 25 years. And if you have a mature company, it gets even tighter, right? You're already a large company. You're looking at Toyota and say, Toyota is a great company. I'm going to put 15% growth. Hey, remember, Toyota already is the largest automobile company in terms of market share. If you put a 15% growth rate in it, where is the growth going to come from? Okay? So you've got to be cautious about growth and start. So when you think about larger companies, think about the scale of the company when you think about how long growth should last. So when you get to that cell on my spreadsheet or your spreadsheet, how long will growth last? Think a little before you put in 15, 10, or even 5 years as to whether that's feasible. So obey the cap. Think about how long growth will last. Third. Yes, go ahead, Kevin. Yep. Right. That's right. That's going to be the point. In fact, that's going to be true for large and small companies. Growth rates by itself are one half of the picture, right? The other half is this growth adding value or not adding value? And what do we need to look at to make that judgment? The growth has to be accompanied with returns which exceed your cost of capital. In fact, that's the third thing I want to emphasize is once you've chosen a growth period and you've chosen a growth rate, make sure you're paying for that growth. And here's how I ensure you pay for the growth. Remember that the growth rate from efficiency is off the table now. You see why? You're now talking about growth rate forever. Don't tell me your company will grow at 2% a year forever because it'll get more efficient, because that's not going to go on forever. It's now all got to be new investment growth, right? Growth from new investments you compute by taking the return on capital times the reinvestment rate. So now if I give you the growth rate and I give you the return on capital, your reinvestment rate backs out. So if your growth rate is 3% and your return on capital is 10%, you have to reinvest 30% every year forever. So here's the final piece of the puzzle. When you tell me the growth rate, here's the next question I'm going to ask you. What return on capital are you going to earn on that growth rate? If you can earn a 20% return on capital, a 3% growth rate, you can get to with a 15% reinvestment rate, which means you have more cash flows, higher terminal value. If you have a 10% return on capital, to get to the same growth rate, you have to reinvest 30% back. Okay? So if you don't tie up that loose end, that's why when analysts sit and play with the growth rate, the value always goes up. Because what do? They change the growth rate, they leave the numerator fixed, right? The cash flow fixed. But you can't do that. If you want to raise the growth rate from 3 to 4%, make sure you reinvest more to get that growth rate. And if that effect is brought into play, you can already see it's a much more tempered effect. Okay? In fact, I'm willing to make the statement that if your return on capital is equal to your cost of capital, you can play with the growth rate as much as you want, but your value as a company will remain unchanged. Okay? In fact, let me give you let me focus on this excess return question, because really the big question then in terminal value is not what will your growth rate be, but what kind of return on capital will you earn to a company that growth rate, right? What kind of excess returns? McKinsey, which I think does some of the best DCF valuations on the street, actually requires everybody doing valuation internally to assume that when they get to terminal value, the return on capital is equal to the cost of capital. Excess returns have to be zero in stable growth. Okay? So if your cost of capital is 8%, they require you to bring the return on capital to 8% in stable growth. So to grow 4% a year with an 8% return on capital, you have to reinvest 50% back. You say, I don't like reinvesting 50% back? Then don't ask me for 4% growth rate. So really the question becomes, is this a reasonable assumption? What McKinsey is doing is forcing the excess returns to zero. Personally, I think it's a little too rigid to make every company go to zero excess returns in stable growth. Because there are companies out there that earn well above the cost of capital. In fact, if you think about growth rates dropping off to stable growth rates, every company that happens quickly, but excess returns actually are much more sustainable. This is from actually their own McKinsey study, which actually is internally at war with their own conclusion. Okay? They actually looked at excess returns at companies, and they discovered that if you look across companies, that companies are able to maintain excess returns for 30, 40, 45 years. That competitive advantages don't fade that fast. You know what the message to us is? Is when you do valuation, if you get to year 10 and you say, my cost of capital is 8%, but I'm going to leave the return on capital at 10% because this company has a brand name, it's not going to fade in 10 years, I can live with that. I can see why your return on capital might be greater than the cost of capital for the long term, for the very long term, and you're building it into the terminal value. But don't leave it at 30%. So even if you believe your company is a great company in stable growth, push the return on capital towards your cost of capital, even if you don't make it exactly equal. And the reason that's going to matter, it's going to determine what reinvestment rate you will have for any given growth rate. So let's summarize. Obey the cap. Okay. Don't let growth last too long before you put in the cap. Make sure you're reinvesting enough to sustain that cap. In fact, here's one point I want to make about this terminal value computation. For those of you who worked in discounted cash flow valuations, you're probably going to be familiar with the set of assumptions I'm going to describe that I see in a lot of terminal value calculations. An analyst tells you that after year 10, your company is going to be a stable growth company. So, okay. He tells you that the growth rate is 3%. So far, we're on safe ground, right? He's obeyed the cap, stable growth company. Then he tells you stable growth companies don't have to reinvest money. Net capex is zero. Capex offsets depreciation. There are no working capital needs. You know, I think this is hard-coded into some valuations. Capex offsets depreciation in stable growth. So if capex offsets depreciation, there are no working capital needs, your reinvestment is zero, right? And you've just told me the growth rate was 3%. There are some mathematical rules. In fact, most mathematical rules you cannot violate. This is obviously one, right? If your reinvestment rate is zero, what's your growth rate going to be? Zero. There is no exception to this rule. No efficiency exception, no inflation exception. In fact, I've heard analysts say, what if I just grow at the inflation rate? I don't have to reinvest money. What's wrong with that argument? I mean, they're not growing the number of units. You should be able to do it to the existing factories. So they're saying, I don't need new factories. Why are you making me reinvest? Why does that argument break down? Anybody? Yeah.
Your depreciation is a historical cost. That would have been 10 years ago, the machinery. If you assume that you want to buy a new machine
To replace the old. Yeah, you can't assume inflation for the good stuff. You're increasing your prices to your customers by 2%, and then when it gets to replacing your own machinery, you say, hey, you know what, the suppliers are going to be really nice and let me keep buying the machine at the cost I paid 10, 15, 20 years ago. If you're going to bring inflation into the cash flows, you've got to bring inflation to reinvestment, which means the rule still stands. There are zero exceptions to this rule as well. If you put in a growth rate and a return on capital and stable growth, the reinvestment rate has to come out of those two. You cannot override that number. You can override it for the first 2-3 years using arguments like there is efficiency in this company. In stable growth, there are no outs. Your growth rate, your return on capital, your reinvestment rate have to be linked up to each other. It's in fact the most common mistake in valuations is in terminal value. See, growth, reinvestment, and return on capital don't match up internally within the same valuation. So that's my final point is let's talk about consistency in your terminal value calculation. We've talked about consistency on what you assume about growth and reinvestment. Also extend that consistency to risk. Do you see why risk is going to be affected as well? You have a high growth company right now. Your beta might be 2, right? So I can understand high growth companies tend to be risky. 10 years from now, you put your company to stable growth. I would expect the beta to go from 2 towards 1. Maybe not to 1, but towards 1. Why? Because if you're a mature company, its risk should reflect the risk of a mature company. Right now, if you're a high growth company with a lot of risk, what's your debt ratio going to look like? Many of you are actually valuing companies like these. Debt ratio is going to be close to 0. You have a high beta, no debt, lots of growth. I can understand. But in mature, you're a stable company in 10 years, your growth rate has dropped to 3%, your debt ratio should probably start moving up. Towards what? Well, if you really want to be industrious, you can compute an optimal debt ratio of your company in 10 years. But if you want a shortcut, you can look at industry averages on debt ratio and say, I would expect my debt ratio for the company to change over time. So make sure that your assumptions about discount rates reflect a stable company as well, because those numbers have to match up to everything else about the company. So you have moving pieces in the terminal value computation, the growth rate, the reinvestment rate, and the risk. Your key is to make sure that they reflect a mature company, not your company as it exists today. It's a very difficult concept, because what I'm saying is if you're valuing Google and you come to the stable growth and you estimate the value of Google, you're talking about a very different company. The only thing it shares with today's company is the name. This is a different company. You cannot say, Google, my beta has to be 2. When you talk about stable growth, it's a mature company. Everything about the company should reflect that maturity. Question? No? So check those. No. Okay. Check those rules. Obey the cap. Make sure that you are, in fact, reinvesting enough to sustain the growth rate. Don't wait too long before you put into stable growth, and check for internal consistency. One final point is, remember those country risk premiums we talked about? Okay, we estimate the country risk using default spreads. And when you get out 5 years, 10 years out, you're going to get another chance to look at those numbers. Don't lock them in. So if you have a risky country right now, you might have a 10%, 12%, 15% country risk premium. When you get to stable growth, you can revisit that number and say, what do I think the country risk premium for this country will look like 5, 10, 15 years out? Okay. It's tough to get a market-driven value for that number, but you can then say, I expect the risk to go down, I expect the country risk premium to decline, and change the risk premium in stable growth relative to what it is today. I mean, the terminal value computation, you're locking everything you put into that equation in forever. So that's why your responsibility of making sure the numbers are numbers you're comfortable with is much greater than what you do in year 1, year 2, year 3, year 4, or year 5. That's about it. Hey, we're not done, so don't put your stuff away. The weekly challenge I will send you later this week is about terminal value. If you get a chance, try it out, because it'll make you understand how much your assumptions about excess returns drive your terminal value. That if your return on capital goes to your cost of capital, your terminal value will be invariant to your growth rate. You can change the growth rate as much as you want, but whatever you gain by using a higher growth rate, you will exactly lose by having a higher reinvestment rate. So we talked about discount rates, cash flows, growth rates, and terminal value. Let's kind of bring the pieces together. I mean, so far it's like we've been playing with 4 boxes of Lego. Let's bring them together to make this final valuation work. Okay. So here are the things we have to decide. First, we have to choose what cash flow we're going to discount. We've defined 3 different variations on cash flows, right? Dividends, free cash flow to equity, free cash flow to the firm. So your first choice is, which of those 3 cash flows do I want to use to value my company? Second question I'm going to ask you is, what discount rate do you want to use? Cost of equity or cost of capital? Your choice in the cash flows, in a sense, is going to determine that second choice. Third, I'm going to ask you, what's your growth rate going to be? Earnings and cash flows, because that's going to determine whether you use a stable growth model, 2-stage, 3-stage, end-stage model. It's combinations of which cash flow you use, which discount rate, what growth pattern you use that will determine what discounted cash flow model you end up with. Okay? So as I go through this, if you're already familiar with at least the numbers for your company, start thinking about which model will be right for my company. Let's start with the first question. Do I want to discount dividends, free cash flows to equity, or free cash flow to the firm? We already talked about the problem with dividends, right? When you focus on dividends, you're trusting the managers to pay out what they can afford to. As a general rule, if you can estimate cash flows to equity, you do not want to use dividends. But the first fork you come to the road then is, do I want to value equity in the company, or do I want to value the entire firm? Right? Think back. When we did free cash flow at equity, we start with net income, we subtracted net capex, we subtracted our change in working capital. And then there were two ways we estimated free cash flow at equity. One was when the debt ratio was stable, in which case we just multiplied those numbers by 1 minus the debt ratio. And the other was when the debt ratio was changing, where we had to estimate principal repayments. And we said it was a pain in the neck to estimate those numbers. So here's a very simple rule to adopt to decide whether you want to value equity of the firm. If you have stable leverage, if you have a firm with a debt ratio is 30%, you feel comfortable that that's going to be the debt ratio in the long term, then I have no problems with using equity valuation, because the free cash flow at equity and the free cash flow of the firm require pretty much the same information, right? But that's if the debt ratio is stable. If the debt ratio is unstable, you expect it to change in either direction, or you don't know. You look at the debt ratio, I have no idea whether it's going to change. The safest thing to do is to value the firm. You know why? Because later in the valuation, if you then want to go back and change the debt ratio, you want to ask what-if questions, it's far easier to do in a firm valuation where all you have to do is change the weights in your cost of capital. Your cash flows are not going to change than it is to try to estimate the cash flows to equity. So first fork on the road, the question I'm going to ask you is, do you feel comfortable with the debt ratio of the firm? If you feel comfortable, you can use an equity valuation. If not, value the firm. So let's say you come to that first fork, you make the choice. So you decide to go the equity valuation route. Now you have a second choice, right? Do I want to use free cash flows to equity or dividends? As I said, there's far more information in the free cash flow to equity than the dividends. So why would I ever use dividends? You know when you use dividends? Is when you get desperate. When do you get desperate? How do I get free cash flow to equity? You take net income, you subtract out net capex, change in working capital, to come to free cash flow to equity. I don't know how many of you are valuing financial service companies, but when you get to this stage of the process for your bank, insurance company, you're going to find yourself at sea. You don't know what the net capex is. There's no working capital in the conventional sense. You're going to very quickly run into a brick wall in trying to estimate those numbers. So here's the rule. If you cannot estimate cash flows, you give up. Then you're stuck using the dividend discount model. With banks, insurance companies, financial service companies, it's almost by default you end up with the dividend discount model because you give up on estimating cash flows. So do not use the dividend discount model if you can actually estimate the free cash flow at equity. But if you really, really have trouble estimating the free cash flow at equity, fall back on dividends because you have no choice. And if you have anything, any company which is not a financial service company, I don't see why you would not be able to estimate free cash flow at equity. But if you do have a financial service company, you might end up with dividends because you cannot estimate cash flows. So the second fork on the road, do I use dividends or free cash flows to equity, really depends on whether you can estimate the free cash flow to equity. If you can estimate the free cash flow to equity, estimate the free cash flow to equity. It'll give you a more reasonable estimate of the value of the equity than trying to focus on dividends and value the dividends. So that's the first question. What cash flow are you going to estimate? Think about leverage. That will tell you firm or equity. Once you've chosen equity, say, can I estimate free cash flow to equity? The answer is yes. Use a free cash flow to equity model. Once you've chosen your cash flow, your discount rate follows, right? Because if you pick free cash flows to equity or dividends as your cash flow to discount, your discount rate has to be the cost of equity. You can't sit there and say, okay, let me try the cost of capital. Remember the Kennecott valuation? You've chosen the cash flow, you've already chosen the discount rate. If you're looking at cash flow to the firm, then make sure the discount rate you picked is the cost of capital. It's also at this stage you might want to make sure that you are working in the same currency for both your cash flows and your discount rates. You decide to value your company nominal pesos, your cash flows and your discount rate have to be nominal pesos. If you're building inflation into one, you've got to build inflation into the other. Right? So check for consistency in terms of the currency. And as a general rule, I think you should stick with nominal cash flows for the very simple reason that taxes are computed based on nominal income. So you can decide to go with real cash flows, but then the problem you're going to run into is your tax rate is not an easy number to compute then, because it's not going to be the 40% that you were given as your tax rate on nominal income. Given a choice, I'd much rather work with nominal income than real income. The only reason I might end up with real cash flows and real income is if inflation is 100. If I'm in Zimbabwe and you force me to do a valuation, I can't use the local currency, right? So I either have to switch to foreign currency or do things in real terms, because inflation is such a huge factor driving the cash flows that I can't even bring it into the analysis. So what discount rate should I use? Look at how you've estimated the cash flows. Make sure your discount rate is in the same terms, equity or firm, real or nominal, and in the same currency in which you're doing the rest of the analysis. Any questions on discount rate consistency? Okay. So you picked a cash flow, you picked the discount rate. Look for what growth pattern you want to use. If your company is already a stable growth company, and how would you know that? What are you checking for? First, you're checking the growth rate, right? It's got to be less than or equal to risk-free rate. Is that enough, though? What else do you want to check for before you put your company into stable growth? Check the risk, right? If you have a beta of 2, it's not stable growth yet. It's not just the growth rate you're going to look at. You're going to look at the risk. You're going to look at the debt ratio, because if you lock everything in at today's numbers, and only the growth rate is below the stable growth rate, you've locked this company in with high growth characteristics with a stable growth rate. So if your company has a low growth rate and has other characteristics that also reflect a mature company, beta close to 1, reasonable debt ratio, reinvestment rate that reflects that growth rate, you're done, right? Your valuation will require only 3 numbers: cash flow next year, cost of capital, growth rate. Then you're going to gloat over the rest of the people in your group, which is fine. If you have a mature company, you don't have to put in a high growth period. If you have a company with a growth rate above the stable growth rate, but within range, 5, 6, 7%, remember again how difficult it is to sustain growth. So if you have a pretty large company, close to mature but not quite mature, put in a growth period, but keep it short, 3 years, 4 years, 5 years, and put it into stable growth, changing the other characteristics to reflect the stable growth. If you're doing the high growth company in your sector, 18, 20, 25%, you might need a transition phase, because it's tough to go from 20 to 3% in 1 year. You might have a 20% growth for the next 5 years and then gradually kind of lower the growth rate over. But use the transition period as a period where everything adjusts, not just the growth rate. Your beta changes, your debt ratio changes, your reinvestment rate changes, all to reflect the stable growth. So what cash flow should I discount? Look at the leverage, make your judgment based on that. What discount rate should I use? You pick the cash flow, your discount rate gets picked for you. What growth pattern should I use? Look at your growth rate for your company. The answer, in a sense, will fall out of that. Yes? Yeah. It's going to be a transition phase. If you want to put in a 20% growth rate, the way you'll differentiate between a Google and an Under Armour is, for Google, you might have 3 years at 20% and a transition phase that lasts only 3 years, because the size is so large. Just shorten the period and split it up, right? Whereas for Under Armour, you might have 10 years of growth. So you have 2 dimensions on which you can play with it. One is whether you have a transition period. The other is how long you make the growth period. And the larger the company, the more conservative you want to get about the growth period. So that might be the way you differentiate between a Google and a smaller company, is how long you allow the growth to last. Okay? So you bring it all together. This is what the pieces of the puzzle look like. You picked a cash flow. You picked a discount rate to match the cash flow. You picked a growth pattern. You bring it together, you got a discounted cash flow model. Every discounted cash flow model is a combination of those 3 choices: cash flow, discount rate, growth period. So there are no new. It's very difficult to think of what's new and different here. Okay? The reason I emphasize it, I know companies out there that have actually patented discounted cash flow models. Sanford Bernstein, for instance, patented a 2-stage dividend discount model. I don't know what do you patent? I mean, what is it that you've created that's new and different? Discounted cash flow valuation, it's really old pieces put together. The biggest thing to do is to make sure you're internally consistent as you put these pieces together. So as you look at your company, don't fall into the trap of just picking in all my Ginzu models, I let you make it a stable growth company, because if you pick a growth period of 0, it'll automatically become a stable growth company. I let you pick the growth period, and I also, if you keep reading the questions, ask you, do you want me in the second phase of your growth period to adjust your growth rate down towards stable growth, which allows you to make it into a 3-stage model. Right? So if you're building your own model, think about that device, because you might say, I'm valuing one company. Why do I need a flexible model? Because you could change your mind. Right? You could value a company today with 10 years of growth, and 6 weeks from now might come back and say, well, I was too optimistic. I'm going to change it to 5. So give yourself the flexibility built into your models as you go along, because then you can change your mind and re-input the numbers. Any questions about modeling choices? Which brings me to the last piece of the DCF puzzle. Right? There's a lot of garnishing in valuation. You know what I mean by garnishing? People spend days, weeks doing stuff, and then at the very end they start doing strange things. Adding premiums for this, discounts for that, 20% for this, 15% for that. In fact, about 4 years ago, was it that long? I took a sabbatical. You know what sabbatical is, right? I mean, we work so hard in academia. I have to work like 2 days a week, like 3 hours a day. It was just overwhelming. That every 6 years, they give us a whole year off with pay. That's pretty common, right? Only in academia. So I get my sabbatical year. And usually when people get sabbaticals, they have all these great plans. I'm going to do this. My sabbatical plan was to do absolutely nothing for a year. I said, I'm going to wake up every day with a to-do list with nothing to do. Imagine nothing to do today, nothing to do tomorrow, nothing to do the day after. The only problem is my wife started noticing that there was nothing to do on my list. She started adding things, like pick up the kids from school. So I decided this was not a good idea to have an empty to-do list, that I had to at least make up things to fill up the list, like I was busy. So it was early in the sabbatical. I get an email from the editor of CFA magazine, a magazine I've actually never read. But to show you how bored I was, the editor said, would you write an article? I said, nothing to do for the day. Let me put this as the to-do, because at least I could say I can't go to the grocery store. I'm working on a big piece today. Right? So I said, today I'm going to do the CFA article. So it's a one-page article. And it's the only article I've ever written that's got me hate mail. You know how difficult it is to get hate mail in valuation? Use bottom-up betas. People don't feel intensely enough that they say, I hate you for doing this, But this one actually got me hate mail for a couple of reasons. One is the title of the article. It's Stop the Garnishing. And what I was talking about is a practice, especially in private company valuation, but also in publicly traded companies, of spending all this time to come up with a DCF value, then adding 20% for control, knocking 15. So I said, you've got to stop this. This is very... I used the word arbitrary, I think, somewhere in the article, which got me into a little bit of trouble. But what really got me into trouble was at the end of the article, I said, what you're doing in valuation is the equivalent of my taking my second son, his name is Brendan, to an expensive Italian restaurant. So what's the big deal here? And every year on their birthdays, my kids are allowed to pick whatever restaurant they want to go to, and we take them there. So Japanese, Indian, Brazilian, whatever, we get them there. For Brendan's now almost 17. Right? First year he couldn't talk, so we picked the restaurant for him, which was actually very convenient. Right? But then he started talking, at which point you lose that, no, you never could talk, so he started picking the restaurant. For the 16 years that he's actually been able to pick a restaurant, he's actually picked the same restaurant every year. It's called Burger King. His vision of a dream dinner is 10-piece chicken nuggets, large order of fries, and a large milkshake, which I don't think has either milk or shake in it, but it's a concoction that resembles a milkshake. In other words, Brendan and flavor don't go in the same sentence. So I said, what we're doing in valuation is the equivalent of my taking Brendan to an expensive Italian restaurant and ordering the most exotic pasta dish on the menu. When I'm talking about the one that comes with capers and green stuff and red stuff and yellow stuff and a sauce on top, if that landed in front of Brendan, he'd freak out. He said, Dad, there's all stuff all over my noodles. I'm not eating this. The only way he'd eat it is if I took it to the sink, washed out every ounce of flavor, in which case, what have I done? I've paid $35 for a bowl of wet noodles, right? I could have done this at home for 35 cents. See, what's this got to do with valuation? Think of how we do valuation. We develop elaborate measures of cash flows. We have discount rates that we spend weeks toiling over. We come up with this elaborate dish that we call a valuation. Then what do? We wash every ounce of flavor off it. Add 20% for control. Knock 25% off for this. Add 15%. You start doing that. Why did we bother? Why didn't we just say the value of the firm is 80? Why go through the charade again of valuing the firm and then kind of moving back to that number? In fact, if you want to see which direction bias is in a valuation, wait till the valuation is done and look at what people do after they say they're done with the valuation. Let's take a couple of examples. What did we say the direction of the bias was in acquisitions? You're an investment bank or in acquisitions, you want your number to be higher, right? There's a lot of premiuming in acquisition valuation. Control premium, add 20%. Synergy premium, add another 25%. In contrast, think about private company appraisers. The two forms private company appraisers work on most, we said, were tax court and divorce court. So you're a private company appraiser. You're valuing a business so the IRS can tax you. Your objective is to make the number a smaller number, right? You're a private company appraiser. You're valuing a business so you can split it halfway with your ex-spouse who you now hate. What do you want the value of your business to be? Close to zero. There's a lot of discounting in private company valuation. Liquidity discounts, actually illiquidity discounts. Knock 25% off. Private company discount. It's kind of when you get desperate. You can't even think of what the discount is. It's a private company. Let me knock another 20% off. And by the time you're done, I'm amazed you actually end up with a value greater than zero. So you use premiums and discounts as a way of kind of backing into your biases. So I write this article. I get a lot of hate mail. People saying, how dare you call it arbitrary? It's not arbitrary. We have science behind us, etc., etc. And most of the emails I just ignored, put in the junk box. One email, though, that cut to the bone. It said, you know what? If you think what we're doing in valuation is wrong, why don't you come up with a better way of doing it? Which I think is a reasonable. Well, does the liquidity matter? Absolutely. What I disagree with is knocking 25% off all the time. Does control matter? Clearly. But why 20%? So I said, you know what? I have nothing to do for the remaining 8 months of my sabbatical. I will take one loose cent every month, and I will try to come up with a better way of valuing liquidity, control, whatever, transparency, all those things you're attaching arbitrary numbers. So I spent the rest of my sabbatical, 1 month at a time, basically, on one loose cent. In fact, anybody have Damodaran on valuation rather than investment valuation? If you have that, the new edition, if you look at the second half of the book, that's my sabbatical right there, because basically the second half of the book is each of these loose ends kind of expanded out. So that's what I'm going to try to do in the next couple of sessions, is I want to go through some of these loose ends. Let me set the table for you on what loose ends are coming. So you've done your DC evaluation, free cash flow of the firm, cost of everything we've talked about so far is to get that first line, right? Value the operating assets. Here's the first loose end I want to come to you with. What's a normal way we deal with cash? You have $5 billion in cash. What do? You just add $5 billion, right? So don't mess with cash. I want to raise a provocative question. Are there circumstances where you see a company with $5 billion in cash? You know there's $5 billion. It's not even a question of debating whether there's $5 billion. You see the $5 billion in cash there, and you discount the cash in the hands of that company. And if so, why? Are there other circumstances where you see a company with $5 billion in cash? Again, no debate about the $5 billion being there, but you attach a premium for the cash. Are there circumstances where you discount or attach premiums to cash? I want to start with that. Then I want to visit an issue which I think is one of the thorniest issues in valuation to deal with, cross-holdings. Many companies in Latin America and Asia own pieces of other companies. How many other companies? 20, 30, 35 other companies. What's the best way? In a perfect information world, how would we deal with cross-holdings, minority as well as majority? And in the real world that we live in, where information is not perfect, how do we value cross-holdings? It's going to be a big issue if you're valuing a Tata Chemicals or you're valuing a company that's part of a group, a piece of the Toyota group. Right? So I want to talk about cross-holdings. Then I want to ask a question. Is there something else I should be adding on? So we've taken the present value of the cash flows. We've added on cash. We've added on cross-holdings. Are there any other assets I should be adding on to this? Have I missed something in my valuation? What if your pension fund is overfunded? Can I take that extra money? So I want to talk about the value of other assets. Once I come up to the value of the firm, I want to talk about, what if your firm is very difficult to value? You're valuing GE. It's driving you crazy, the information that's being held back. Should you punish a company for making life difficult for you? Think of how satisfying that would be. I'll knock off 20% of my value. Your 10K was really difficult to read. You are holding back information. Should we punish companies for being opaque? Okay? I also want to talk about synergy. Big issue in mergers, but I'll kind of hold off on the synergy discussion till we talk about acquisition valuation, but at least mention what the value of synergy is. What about intangibles? Intangible assets, big issue in accounting, right? Brand name, customer list. What's the value of those intangibles? Then I want to revisit a number I thought we'd already nailed down. When we talked about debt for cost of capital, we talked about using a narrow definition of debt, interest-bearing debt, maybe leases. I want to revisit that question again in a different context. You value the firm now. What should I be subtracting out as debt? Book value or market value? What about underfunded pension obligations? What if I have litigation against me? This is your last chance to bring all those worries into your valuation. What should I be subtracting out of that? Once I value the equity, I want to return this issue of control. What is the value of control? Okay? Again, this is an issue I'll come back to in more depth later because it's going to be a big factor driving valuation is what you attach to the value of control, but I want to talk about that. But one issue that we will spend a lot of time on Wednesday, spilling over into Monday, is what do we do with these equity options that companies have been granting to managers? Not just options that have been granted already, the overhang that you have, but options I expect a company to grant as part of its compensation package next year, 2 years out, 3 years out, 5 years out. And the last thing I want to talk about, and this is again something we'll come back to in more depth later, is liquidity. What's the cost of liquidity? How do I bring that into the valuation? And how do I differentiate across different companies which might be illiquid to different degrees? Okay? So when we start on Wednesday, we will start with cash and start to work down, but start thinking about these issues, discount or premium for cash, cross holdings, etc.